Welcome to Contrarian Edge, where financial truth defies the herd. I'm your host, and today we're re-diving deep into what could be the most significant wealth transfer event of our generation. While mainstream media focuses on daily market noise, we're here to decode the real signals that matter for your financial future. Picture this. It's early 2025, and you're watching the news. Headlines scream about market volatility, currency devaluations, and economic uncertainty. But here's what they won't tell you. This isn't chaos. This is a carefully orchestrated reset of the global financial system. And those who understand the game are positioning themselves to profit massively while others lose everything. The year 2025 isn't just another year in the economic calendar. According to the International Monetary Fund's World Economic Outlook 2024, global economic growth is projected to slow to just 3.2% in 2025, well below the historical average of 3.8%. But behind these seemingly dry statistics lies a story of unprecedented opportunity for those brave enough to think differently. We're witnessing the largest monetary experiment in human history finally reaching its breaking point. Since the 2008 financial crisis, central banks worldwide have pumped over $25 trillion into the global economy through quantitative easing programs. The Federal Reserve alone expanded its balance sheet from $900 billion in 2008 to over $8.9 trillion at its peak in 2021. This is unsustainable, and the cracks are already showing. The COVID-19 pandemic accelerated this monetary madness, according to World Bank data. But here's where it gets interesting. While most people focus on the problems, smart money is already moving. The ultra-wealthy aren't panicking, they're positioning. They understand that every great crisis creates even greater opportunities. The question is, will you be on the right side of this wealth transfer? Let's look at the numbers that matter. Global inflation, which the IMF projects at 5.9% for 2024, is still well above central bank targets. This is just a temporary blip. It's a structural shift that's forcing a complete reevaluation of asset values worldwide. When money loses its purchasing power this rapidly, everything changes. The traditional safe havens are crumbling. U.S. Treasury bonds, once considered the ultimate risk-free asset, lost 15% of their value in 2022, according to Bloomberg data. This wasn't supposed to happen. Government bonds were meant to be boring, stable, and safe. But when you have $33 trillion in U.S. national debt and rising interest rates, even the safest assets become dangerous. Meanwhile, the global financial system is showing signs of severe stress. The collapse of Silicon Valley Bank in March 2023 was an isolated incident. It was a warning shot. The bank failed because it was loaded with long-term government bonds that became worthless when interest rates rose. If a bank can fail because it owned too many safe government bonds, what does that tell you about the system? Foreign central banks are already voting with their feet. China, once the largest foreign holder of U.S. Treasury securities, has reduced its holdings from $1.3 trillion in 2014 to just $769 billion by the end of 2023, according to U.S. Treasury data. Japan, the second largest holder, has also been quietly reducing its exposure. When your biggest creditors start walking away, you know something fundamental has changed. The currency wars are intensifying. The Japanese yen lost over 20% of its value against the U.S. dollar in 2023. Forcing the Bank of Japan to intervene multiple times, the European Central Bank is struggling to maintain the euro's stability. While dealing with energy crises and geopolitical tensions, even emerging market currencies are under unprecedented pressure, with some experiencing double-digit devaluations. But here's what the mainstream financial media won't tell you. This isn't a bug in the system. It's a feature. The current monetary system was designed to transfer wealth from savers to debtors, from the prudent to the reckless, from the many to the few. And 2025 is when this transfer accelerates dramatically. The smart money isn't just sitting in cash or traditional investments anymore. According to the latest data from the Bank for International Settlements, global capital flows, totaling over $100 trillion annually, are beginning to shift toward alternative assets. Gold purchases by central banks reached a 55-year high in 2023, with 1,037 tons purchased, according to the World Gold Council. These aren't retail investors buying gold coins. These are sophisticated institutions preparing for what's coming. The real estate market is already showing cracks. Commercial real estate vacancy rates in major U.S. cities have reached 20%, according to CBRE data, the highest since the 2008 financial crisis. The shift to remote work isn't temporary, it's permanent, and it's destroying the value of billions of dollars in commercial property. But while commercial real estate crumbles, residential properties in strategic locations continue to appreciate, creating a massive divergence in the market. Technology is reshaping everything. The artificial intelligence revolution is just changing how we work. It's creating entirely new asset classes and destroying others. The Nasdaq gained 43% in 2023, driven largely by AI-related stocks, while traditional value stocks languished. This isn't a bubble. It's a fundamental shift in how value is created and stored in the modern economy. Energy markets are in flux. Despite all the talk about renewable energy, global oil demand continues to grow, and supply constraints are becoming more apparent. The Energy Information Administration projects that oil prices could surge if geopolitical tensions escalate, or if supply disruptions occur. Smart investors are positioning themselves in energy assets, while others chase the latest tech fad. The cryptocurrency market, despite its volatility, is maturing rapidly. Bitcoin gained over 150% in 2023, according to CoinMarketCap data. And institutional adoption continues to accelerate. Major corporations and even nation-states are beginning to hold Bitcoin as a treasury asset. This isn't speculation anymore. It's strategic positioning for a world where traditional currencies become unreliable. As we stand at the threshold of 2025, we not just facing another market cycle. We witnessing the end of the post-World War II monetary order. The Bretton Woods system collapsed in 1971, and what replaced it is now collapsing too. What comes next will determine the financial landscape for the next generation. The question isn't whether this transformation will happen. It's already happening. The question is whether you'll be prepared to profit from it or become another casualty of financial ignorance. In the coming segments, we'll break down exactly which assets are most vulnerable, why they're failing, and most importantly, where the smart money is moving to protect and grow wealth in this new paradigm. Remember, at Contrarian Edge, we don't follow the crowd, we lead it. While others panic, we prepare. While others follow, we think ahead. If this analysis resonates with you and you want to stay ahead of the financial curve, make sure to hit that subscribe button and ring the notification bell. Share this video with anyone who needs to hear this message, and let me know in the comments. What's your biggest concern about the financial changes coming in 2025? The Great Reset is coming. The only question is, will you be ready? To understand what's coming in 2025, we need to decode how money actually moves around the world. Most people think of money as static, sitting in bank accounts, invested in stocks, or tucked away in bonds. But money is like water. It's always flowing, always seeking the path of least resistance, always moving toward the highest returns adjusted for risk. Right now, we're witnessing the largest redirection of global capital flows in modern history. According to the Bank for International Settlements, daily foreign exchange trading volumes exceed $7.5 trillion. That's more than the entire GDP of Japan changing hands every single day. When flows this massive start shifting direction, entire economies can be transformed overnight. The traditional flow patterns that have dominated for decades are breaking down. For the past 40 years, money has flowed in predictable cycles, from developed markets to emerging markets during risk-on periods, back to safe havens like U.S. Treasuries during risk-off periods. But this pattern is fracturing because the so-called safe havens are no longer safe. The Federal Reserve's role in this transformation cannot be overstated. When the Fed raised interest rates from near 0 to 5.25 to 5.5% between 2022 and 2023, it didn't just affect American borrowers. It created a global vacuum that sucked capital back to the United States. This caused emerging market currencies to collapse and forced developing nations to raise their own rates defensively, crushing their economies in the process. But here's the twist that most analysts miss. The Fed's rate hikes have created a trap for the U.S. government itself. With $33 trillion in national debt, every percentage point increase in interest rates adds roughly $330 billion to annual interest payments. The U.S. government now spends more on interest payments than on defense, over $640 billion annually, according to Treasury data. This is unsustainable, and the Fed knows it. The European Central Bank faces an even more complex challenge. Europe's economy is structurally weaker than America's, with lower productivity growth and higher energy costs following the Ukraine conflict. Yet the ECB has been forced to raise rates to defend the euro, even though higher rates are crushing European businesses. European corporate bankruptcies increased by 8.4% in 2023, according to Euler Hermes data. And this trend is accelerating. Meanwhile, the Bank of Japan finds itself in an impossible position. Japan has the highest debt-to-GDP ratio of any major economy at over 260%. They literally cannot afford to raise interest rates significantly without bankrupting their own government. So they're trapped at near-zero rates while their currency collapses. The yen's 20% decline in 2023 wasn't an accident. It was the inevitable result of this monetary prison. China presents perhaps the most interesting case study. The People's Bank of China has been quietly reducing its holdings of U.S. Treasury securities, while simultaneously accumulating gold and other hard assets. China's gold reserves increased by 225 tons in 2023 alone, according to official data, though many analysts believe the actual purchases are much higher. This isn't random. It's strategic preparation for a world where the dollar's dominance is challenged. The petrodollar system, which has underpinned American monetary hegemony since the 1970s, is showing cracks. Saudi Arabia, the cornerstone of this system, has begun accepting Chinese yuan for oil payments. Russia and Iran are trading energy in rubles and other currencies. These aren't just political gestures. They're the early stages of a fundamental restructuring of global trade flows. corporate treasuries are also shifting their strategies. Apple holds over $29 billion in cash and short-term investments, but they're increasingly diversifying away from traditional bank deposits. Microsoft has allocated portions of its treasury to Bitcoin and other alternative assets. When the world's largest corporations start questioning the safety of traditional monetary instruments, you know something fundamental has changed. The insurance industry provides another crucial indicator of changing money flows. Life insurance companies and pension funds manage over $35 trillion globally, and they're facing an unprecedented crisis. Their traditional strategy of buying long-term government bonds to match long-term liabilities has backfired spectacularly. Many insurance companies are technically insolvent if they mark their bond portfolios to market value. Private equity and hedge funds are adapting faster than traditional institutions. Blackstone, the world's largest alternative asset manager, has been shifting away from traditional real estate and toward data centers, logistics facilities, and energy infrastructure. They understand that the old economy is dying and the new economy requires different types of assets. Sovereign wealth funds, which control over $40 trillion in assets globally, are also repositioning. Norway's government pension fund, Global, the world's largest sovereign wealth fund, has been reducing its exposure to European assets and increasing investments in American technology companies and Asian infrastructure projects. These funds have access to the best financial minds in the world, and they're voting with their wallets. The cryptocurrency market, despite representing less than 2% of global financial assets, is having an outsized impact on money flows. Bitcoin's market capitalization exceeded $800 billion in 2023, larger than the GDP of most countries. More importantly, Bitcoin is beginning to function as a global settlement layer for international transactions, bypassing traditional banking systems entirely. Central bank digital currencies, CBDCs, represent another major shift in money flows. Over 100 countries are exploring or developing CBDCs, according to the Atlantic Council's CBDC tracker. China's digital yuan is already being used for over $250 billion in transactions annually. These aren't just technological upgrades, they're tools for monetary control that could fundamentally alter how money moves around the world. The derivatives market, worth over $600 trillion in notional value, is where the real action happens. Interest rate swaps, currency forwards, and credit default swaps are the plumbing of the global financial system. When this plumbing starts to crack, as it did with the collapse of Credit Suisse in 2023, the effects ripple through every asset class and every economy. Commodity flows are also shifting dramatically. China now consumes over 50% of global copper production, 60% of global iron ore, and 55% of global aluminum. But China's economy is slowing, and their demand for raw materials is plateauing. This is forcing commodity producers to find new markets and is reshaping global trade patterns. Energy flows are perhaps the most geopolitically sensitive. The United States has become the world's largest oil producer, fundamentally altering global energy dynamics. Meanwhile, renewable energy investments exceeded $1.8 trillion globally in 2023, according to the International Energy Agency, creating entirely new capital flows toward solar, wind, and battery technologies. Real estate capital flows are fragmenting along geographic and sector lines, while commercial real estate in major cities faces headwinds. Industrial real estate and data centers are seeing massive inflows. Residential real estate in climate-resilient locations continues to attract capital. while properties in climate-vulnerable areas are being quietly abandoned by institutional investors. The art and collectibles market, worth over $400 billion globally, has become an alternative store of value for ultra-high net worth individuals. When traditional assets become unreliable, people turn to tangible objects with intrinsic value. This trend is accelerating as more wealthy individuals lose faith in paper assets. Technology, transfer, and intellectual property flows are becoming increasingly important. The global market for technology licensing exceeds $350 billion annually, and control over key technologies like semiconductors, artificial intelligence, and quantum computing is becoming a matter of national security. Countries and companies are hoarding technological assets like previous generations hoarded gold. Understanding these money flows isn't just academic, it's practical. Every major investment decision should consider where capital is flowing and why. The investors who profit most in the coming transformation will be those who position themselves ahead of these flows, not those who chase them after they've already moved. The key is to think like money itself, always flowing, always seeking the best risk-adjusted returns, always one step ahead of the crowd. For over 7 decades, U.S. Treasury bonds have been considered the bedrock of global finance. They've been called risk-free assets, the ultimate safe haven where investors parked their money during turbulent times. But 2025 may be the year this fundamental assumption gets shattered, and the implications will ripple through every corner of the global financial system. The numbers tell a stark story. In 2022, long-term Treasury bonds experienced their worst performance since the Civil War, losing over 15% of their value, according to Bloomberg data. This wasn't supposed to happen. Government bonds were meant to be boring, stable, and predictable. But when you combine $33 trillion in national debt with rapidly rising interest rates, even the safest assets become dangerous. To understand why Treasury bonds are vulnerable, we need to grasp a fundamental principle of bond mathematics. When interest rates rise, bond prices fall. It's an inverse relationship that's as reliable as gravity. If you own a 10-year Treasury bond paying 2% interest and new bonds are issued paying 5%, your bond becomes worth significantly less. The longer the maturity, the more dramatic the price decline. Here's where it gets scary for the financial system. Banks, insurance companies, pension funds, and money market funds collectively hold over $24 trillion in Treasury securities, according to Federal Reserve data. These institutions bought these bonds when rates were near zero, thinking they were making safe investments. Now they're sitting on massive unrealized losses that threaten their solvency. The Silicon Valley Bank collapse in March 2023 was a preview of what's coming. SVB failed not because of bad loans or risky investments, but because it was loaded with long-term Treasury bonds that became worthless when rates rose. The bank was forced to sell $21 billion in securities at a $1.8 billion loss, triggering a bank run that destroyed the institution in 48 hours. If this can happen to a bank holding safe government bonds, what does that tell you about the system's stability? The Federal Reserve finds itself in an impossible position. They need to keep raising rates to fight inflation, but every rate increase destroys more value in the Treasury market. The Fed's own balance sheet holds over $5 trillion in Treasury securities, and they're facing hundreds of billions in unrealized losses. For the first time in its history, the Federal Reserve is technically insolvent on a mark-to-market basis. Foreign central banks are already voting with their feet. China has reduced its Treasury holdings from $1.3 trillion in 2014 to just $769 billion by the end of 2023. Japan, despite being America's closest ally, has also been quietly reducing its exposure. When your biggest creditors start walking away, it signals a fundamental loss of confidence in your debt. The auction dynamics are becoming increasingly problematic. The U.S. Treasury needs to issue over $2 trillion in new debt annually just to refinance maturing bonds and fund government operations. But with foreign demand declining and domestic banks unable to absorb more duration risk, who's going to buy all these bonds? The answer is increasingly the Federal Reserve itself, which means more money printing and more inflation. Interest payments on the national debt have exploded from $345 billion in 2022 over $640 billion in 2023, according to Treasury data. This represents nearly 15% of total federal spending, and it's growing rapidly. Every percentage point increase in average borrowing costs adds roughly $330 billion to annual interest expenses. At current debt levels, if average rates return to their historical norm of 5 to 6%, interest payments alone would consume over $1.8 trillion annually. Nearly half of all federal revenues. The debt ceiling debates that periodically royal markets are just a sideshow. The real issue is debt sustainability. The Congressional Budget Office projects that debt to GDP will reach 181% by 2053 under current policies. But this assumes benign interest rate environments and steady economic growth. If rates stay elevated or the economy enters recession, these projections become much worse, much faster. Corporate pension funds are facing a crisis of their own. Many defined benefit pension plans assumed they could earn 7 to 8% annual returns by investing in a mix of stocks and bonds. But with bond yields near zero for over a decade, these plans loaded up on longer duration securities to chase yield. Now they're facing massive funding shortfalls as their bond portfolios crater. General Electric's pension plan alone reported $31 billion in unfunded liabilities in 2023, largely due to bond losses. Insurance companies are in even worse shape. Life insurers sold millions of policies promising guaranteed returns, and they invested the premiums in long-term treasury bonds to match their long-term liabilities. Companies like New York Life and Northwestern Mutual are sitting on tens of billions in unrealized bond losses. If they are forced to realize these losses, many could become insolvent overnight. Money market funds, which manage over $5.6 trillion and are supposed to be ultra-safe, are also at risk. These funds invest in short-term treasury bills and commercial paper. But even short-term rates can cause problems if they rise too quickly. In March 2023, several money market funds experienced significant outflows as investors fled to higher-yielding alternatives. The repo market, where financial institutions borrow against treasury collateral, is showing signs of stress. Daily repo volumes exceed $4 trillion, making it one of the largest financial markets in the world. But when treasury bonds lose value, the collateral backing these transactions becomes less reliable. This could trigger a liquidity crisis similar to what happened in September 2019, when repo rates spiked to over 10% overnight. International implications are equally severe. Treasury bonds serve as collateral for trillions of dollars in global transactions. They're used in currency swaps, derivatives contracts, and international trade finance. If confidence in treasury bonds erodes, it could disrupt global commerce and trigger a dollar funding crisis that makes 2008 look mild by comparison. The Federal Reserve's quantitative tightening program is making everything worse. The Fed is allowing $95 billion in Treasury securities to mature each month without replacement. Effectively removing this demand from the market, combined with reduced foreign buying, this creates a massive supply-demand imbalance that puts downward pressure on bond prices. Credit rating agencies are starting to take notice. While the U.S. still maintains its AAA rating from most agencies, Fitch downgraded U.S. debt from AAA to AA+ in August 2023, citing fiscal deterioration and governance issues. If other agencies follow suit, it could trigger forced selling by institutions that are required to hold only AAA-rated securities. The derivatives market adds another layer of complexity. Interest rate swaps tied to Treasury yields have a notional value exceeding $400 trillion globally. Small moves in Treasury yields can trigger massive margin calls and forced liquidations in this market. The collapse of Credit Suisse in 2023 was partly attributed to losses in interest rate derivatives tied to Treasury movements. Municipal bonds, which are often considered nearly as safe as Treasuries, are also vulnerable. Many municipal bond funds and ETFs use Treasury bonds as hedging instruments. When Treasury bonds fall, these hedges become liabilities, amplifying losses in the municipal market. This could trigger a crisis in state and local government financing. The psychological impact cannot be understated. For 3 generations, investors have been conditioned to believe that Treasury bonds are risk-free. When this belief is shattered, it will trigger a fundamental reassessment of risk across all asset classes. The flight to safety that typically benefits bonds during market stress could reverse, creating a vicious cycle of selling pressure. Exchange-traded funds, ETFs that hold Treasury bonds manage over $1.2 trillion in assets. These funds promise daily liquidity to investors, but they hold bonds that can be difficult to sell quickly in stressed markets. If investors rush for the exits simultaneously, these ETFs could be forced to sell bonds at fire sale prices, accelerating the decline. The Treasury bond market isn't just another asset class. It's the foundation upon which the entire global financial system is built. When the foundation cracks, everything built on top of it becomes unstable. This is why the potential collapse of Treasury bond values represents the first and most dangerous domino in the coming financial reset. While Treasury bonds represent the institutional foundation of the financial system, cash represents the everyday reality for billions of people worldwide. But in 2025, holding cash, especially in certain currencies, could be one of the most dangerous financial decisions you can make. The era of fiat currency dominance is entering its final phase, and the implications for ordinary savers are catastrophic. The mathematics of currency debasement are relentless and unforgiving. Since the Federal Reserve was created in 1913, the U.S. dollar has lost over 96% of its purchasing power. But this decline has accelerated dramatically in recent years. According to Federal Reserve data, the real purchasing power of the dollar declined by approximately 7% in 2022 alone, the fastest pace since the 1970s stagflation crisis. The money supply expansion since 2020 has been unprecedented in peacetime. The M2 money supply, which includes cash, checking deposits, and ISILY convertible near money, expanded by over 40% between February 2020 and April 2021. To put this in perspective, it took nearly 4 decades for the money supply to double from 1980 to 2020, but it increased by 40% in just 14 months during the pandemic response. This isn't just an American phenomenon. The European Central Bank expanded its balance sheet by over 4.2 trillion euros through various quantitative easing programs. The Bank of Japan's balance sheet now exceeds 130% of Japan's GDP, an unprecedented level for any major economy. The Bank of England, the People's Bank of China, and virtually every other major central bank has engaged in similar monetary expansion. The immediate consequence is inflation, but the long-term consequence is currency collapse. Turkey provides a stark example of what happens when monetary policy loses credibility. The Turkish lira lost over 80% of its value against the dollar between 2018 and 2023, wiping out the savings of millions of Turkish citizens. President Erdogan's insistence on keeping interest rates low despite soaring inflation turned the lira into worthless paper. Argentina offers another cautionary tale. The Argentine peso has lost over 90% of its value against the dollar since 2018. Inflation reached 211% annually in 2023, forcing ordinary Argentinians to convert their pesos to dollars immediately upon receiving them. The government has imposed capital controls, currency restrictions, and multiple exchange rates, but these measures only accelerate the currency's decline. The Japanese yen's 20% decline in 2023 shocked global markets because Japan was supposed to be different. As the world's third-largest economy with a current account surplus and massive foreign reserves, the yen was considered stable. But when you have a debt-to-GDP ratio exceeding 260% and interest rates pinned near zero, even the yen becomes vulnerable to currency attacks. The British pound's collapse in September 2022 demonstrated that even reserve currencies aren't immune. When Prime Minister Liz Truss announced unfunded tax cuts, the pound fell to near parity with the dollar, and gilt yields spiked so dramatically that the Bank of England was forced to intervene to prevent a pension fund crisis. The episode lasted only weeks, but it showed how quickly confidence can evaporate. Emerging market currencies are facing even more severe pressures. The Egyptian pound has been devalued multiple times, losing over 50% of its value since 2022. The Pakistani rupee, Sri Lankan rupee, and Lebanese pound have all experienced dramatic declines. These aren't isolated incidents, they're symptoms of a global monetary system under extreme stress. The velocity of money, how quickly money changes hands in an economy, is a crucial indicator of currency health. When people lose confidence in their currency, they spend it as quickly as possible, accelerating inflation and currency decline. This velocity effect is already visible in several countries and could spread to major currencies if confidence continues to erode. Central bank digital currencies, CBDCs, represent both a response to and an acceleration of the currency crisis. Over 100 countries are exploring CBDCs, but these aren't solutions. They're admissions that the current system is failing. CBDCs give governments unprecedented control over money flows, including the ability to impose negative interest rates, track every transaction, and even expire money that isn't spent quickly enough. China's digital yuan is already being used for over $250 billion in transactions annually, and the Chinese government is using it to monitor and control economic activity. The European Central Bank is developing a digital euro that would allow them to bypass commercial banks entirely. These systems aren't being developed to improve efficiency. They're being developed to maintain control as the old system collapses. The dollar's role as the global reserve currency provides temporary protection, but this status is being challenged systematically. The BRICS nations Brazil, Russia, India, China, and South Africa are developing alternative payment systems that bypass the dollar entirely. Russia and China are conducting bilateral trade in rubles and yuan. Saudi Arabia is accepting yuan for oil payments. These developments are gradually eroding the dollar's monopoly on international trade. Oil markets are particularly important because energy transactions have underpinned dollar demand since the 1970s petrodollar agreement. But this system is fragmenting. Russia is selling oil to India in rupees. Iran is trading oil for Chinese goods. Venezuela is accepting gold for oil. Each of these transactions reduces global demand for dollars and weakens America's monetary hegemony. The carry trade phenomenon is creating additional currency instability. Investors borrow in low-yielding currencies like the yen and invest in higher-yielding assets elsewhere. This works until it doesn't. When market stress forces unwinding of these trades, it can trigger massive currency moves. The yen's volatility in 2023 was partly due to carry trade unwinding as global risk appetite declined. Commercial banks are quietly preparing for currency instability. J.P. Morgan Chase has increased its gold holdings and is developing blockchain-based payment systems that could function independently of traditional currencies. Bank of America has warned clients about currency risks and is recommending diversification into hard assets. When the banks that create money start hedging against their own currencies, you know something fundamental has changed. Corporate treasuries are also adapting. Tesla holds Bitcoin on its balance sheet. MicroStrategy has converted most of its treasury to Bitcoin. Even traditional companies like Coca-Cola and McDonald's are exploring cryptocurrency payments in certain markets. These aren't speculative bets. They're insurance policies against currency debasement. The insurance industry faces particular challenges from currency instability. Life insurance policies and annuities promise fixed payments decades into the future. But these promises become worthless if the underlying currency collapses. Some insurers are beginning to offer policies denominated in gold or other hard assets, recognizing that fiat currency promises may not be sustainable. Pension funds managing trillions in retirement savings are trapped in a currency debasement scenario. They're required to match long-term liabilities with long-term assets. But if the currency loses purchasing power, even fully funded pensions become inadequate. The California Public Employees Retirement System CalPERS and other major pension funds are beginning to allocate to inflation-protected assets, but their options are limited. Real estate has traditionally been viewed as an inflation hedge, but currency collapse can overwhelm even real estate values. In countries experiencing hyperinflation, real estate prices often fail to keep pace with currency debasement, especially when measured in hard currency terms. Venezuelan real estate prices have collapsed in dollar terms, despite soaring in bolivar terms. The psychological aspects of currency collapse are as important as the economic fundamentals. Once people lose confidence in their money, the decline becomes self-reinforcing. Citizens rush to convert their savings to hard assets or foreign currencies, accelerating the debasement. This process can happen gradually over years or suddenly over weeks, depending on the triggering events. International remittances, which exceed $800 billion annually, according to World Bank data, are increasingly bypassing traditional banking systems. Migrant workers are using Bitcoin and other cryptocurrencies to send money home, avoiding both high fees and currency conversion losses. This trend reduces demand for traditional currencies and accelerates the adoption of alternative monetary systems. The foreign exchange market, with daily volumes exceeding $7.5 trillion, is where currency crises play out in real time. But this market is dominated by a handful of major banks and hedge funds that can manipulate smaller currencies through coordinated trading. When these players decide a currency is vulnerable, they can trigger massive selling pressure that overwhelms central bank intervention attempts. Gold purchases by central banks reached a 55-year high in 2023, with 1,037 tons purchased, according to the World Gold Council. This isn't coincidental. Central bankers understand that their own currencies are becoming unreliable stores of value. When the people who create money start hoarding gold, it sends a clear signal about the future of fiat currencies. The cash crisis isn't coming. It's already here. The question isn't whether currencies will lose value, but which ones will lose value fastest and which alternatives will emerge to replace them. For individuals and institutions holding significant cash positions, 2025 could be the year that decades of savings evaporate through currency debasement. The stock market has been the wealth-building engine for generations of investors. But 2025 may reveal that much of this wealth was built on monetary illusion rather than genuine economic value. As interest rates normalize and monetary policy tightens, the artificial support that has inflated equity valuations for over a decade is being systematically removed, setting up traditional stocks for a devastating correction. The numbers paint a sobering picture of market distortion. The S&P 500's price-to-earnings ratio reached 25 times earnings in 2024, significantly above the historical average of 15 to 20 times according to Bloomberg data. This isn't just expensive, it's bubble territory that rivals the dot-com peak of 2000. But unlike the tech bubble, which was confined to one sector, today's overvaluation spans the entire market. The Federal Reserve's zero interest rate policy from 2008 to 2022 created the largest asset bubble in human history. When money is essentially free, investors bid up the prices of everything, regardless of underlying fundamentals. Companies could borrow cheaply to buy back their own shares, artificially inflating earnings per share without improving actual business performance. According to S&P Dow Jones Indices, companies in the S&P 500 spent over $5.1 trillion on share buybacks between 2010 and 2023. The Tina effect, their no alternative, drove massive flows into equities as bonds yielded nothing and cash earned zero returns. But now that Treasury bills yield over 5%, suddenly there are alternatives to stocks. Pension funds, insurance companies, and individual investors can earn meaningful returns in risk-free government securities, reducing the appeal of volatile equities. The concentration risk in today's market is unprecedented. The top 10 stocks in the S&P 500 represent over 30% of the index's total market capitalization, according to S&P Global data. Apple alone has a market cap exceeding $3 trillion, larger than the entire GDP of most countries. When a handful of companies dominate market performance to this degree, the entire index becomes vulnerable to sector-specific shocks. Technology stocks, which led the market higher for over a decade, face particular challenges. The artificial intelligence boom of 2023 drove companies like NVIDIA to astronomical valuations, with the stock gaining over 200% in a single year. But AI adoption is proving slower and more expensive than anticipated. and many AI investments are generating losses rather than profits. The gap between AI hype and AI reality is creating conditions for a major correction. The passive investing revolution has created dangerous feedback loops in equity markets. Index funds and ETFs now control over $15 trillion in assets, according to investment company Institute data. These funds buy stocks not based on fundamental analysis, but simply because they're included in an index. This mechanical buying has inflated the prices of index constituents while starving smaller companies of capital. When markets decline, passive funds become forced sellers, amplifying the downward pressure. The March 2020 crash demonstrated this dynamic when ETF outflows forced massive selling across all sectors, regardless of individual company fundamentals. The next major correction could be even more severe, as passive investing has grown substantially since 2020. Corporate earnings quality has deteriorated significantly over the past decade. Many companies have used accounting gimmicks, one-time charges, and non-GAAP metrics to present inflated earnings figures. According to research by NYU's Stern School of Business, the gap between reported earnings and actual cash flows has widened dramatically, suggesting that much of the apparent earnings growth is illusory. The private equity and venture capital bubble is beginning to burst, with implications for public markets. Private equity firms raised over $1.2 trillion in 2021 to 2022, much of it at inflated valuations. As these investments mature and seek public market exits through IPOs, they're discovering that public market investors are no longer willing to pay bubble prices. The collapse in IPO activity, down over 80% from peak levels, signals a fundamental repricing of growth expectations. Dividend-paying stocks, traditionally considered conservative investments, face a particular challenge in the new interest rate environment. When 10-year Treasury bonds yield 4 to 5%, dividend stocks yielding 2 to 3% lose their appeal. Utility stocks, REITs, and consumer staples that investors bought for income are becoming relative value traps as bond yields rise. The situation is worse for companies that borrowed heavily during the zero-rate era. According to Federal Reserve data, non-financial corporate debt reached $18.8 trillion by the end of 2023, up from $7.4 trillion in 2008. Much of this debt was issued at low fixed rates, but as companies need to refinance, they're facing dramatically higher borrowing costs that will crush profit margins. Zombie companies, firms that can service their debt but cannot grow or invest meaningfully, represent a significant portion of the market. Bank for International Settlements research suggests that over 20% of publicly traded companies in developed markets qualify as zombies. These companies survived the low-rate environment, but will struggle to survive in a normalized rate environment. The meme stock phenomenon revealed the speculative excess that has infected equity markets. GameStop, AMC, and dozens of other companies saw their stock prices increase by hundreds or thousands of percent, based purely on social media hype rather than business fundamentals. While these specific bubbles have largely deflated, the speculative mindset they represent remains embedded in market psychology. Options trading has exploded among retail investors, with daily options volume often exceeding stock volume, according to CBOE data. Much of this activity consists of short-dated out-of-the-money calls that amount to lottery tickets rather than investments. This speculative activity has created artificial demand for certain stocks and increased overall market volatility. The corporate bond market provides another warning signal for equity investors. Investment-grade corporate bond spreads have widened significantly as investors demand higher compensation for credit risk. If bond investors are becoming more cautious about corporate credit, equity investors should be even more concerned as stocks rank below bonds in the capital structure. International equity markets are already showing signs of stress. Chinese stocks have underperformed dramatically as the country's economy slows and geopolitical tensions rise. European stocks face challenges from energy costs, regulatory pressures, and economic stagnation. Emerging market equities are being crushed by dollar strength and capital flight. The demographic headwinds facing developed market equities are substantial. Baby boomers are entering retirement and shifting from accumulation to distribution mode, meaning they're becoming net sellers of stocks rather than buyers. This demographic shift will persist for decades and represents a fundamental change in equity demand patterns. Environmental, social, and governance. ESG investing, which attracted massive flows in recent years, is facing a backlash. Political opposition to ESG mandates and disappointing performance of ESG. Funds are causing investors to reconsider these strategies. As ESG flows reverse, the stocks that benefited from this thematic investing could face significant selling pressure. The correlation between stocks and bonds, which traditionally moved in opposite directions, has broken down. In 2022, both stocks and bonds declined simultaneously, eliminating the diversification benefits that investors relied upon. This correlation breakdown suggests that traditional portfolio construction methods may no longer provide adequate protection during market stress. Algorithmic and high-frequency trading now account for over 70% of equity. Trading volume according to various industry estimates, these systems can amplify market moves in both directions, creating flash crashes and melt-ups that have little relationship to fundamental value. The increasing dominance of algorithmic trading makes markets more fragile and prone to sudden, severe corrections. The derivatives market adds another layer of complexity and risk to equity markets. The notional value of equity derivatives exceeds $15 trillion globally, creating massive leverage in the system. When these derivatives need to be hedged or unwound, they can create forced buying or selling that overwhelms natural market forces. Stock buyback programs, which have been a major source of equity demand, are becoming less attractive as borrowing costs rise. Companies that previously borrowed money to repurchase shares are finding that the math no longer works when debt costs exceed potential returns. The reduction in buyback activity removes a significant source of artificial demand from equity markets. The venture capital ecosystem, which has funded much of the innovation economy, is contracting rapidly. Venture funding fell by over 50% in 2023 compared to 2021, levels according to PitchBook data. This contraction means fewer IPOs, less innovation funding, and reduced growth prospects for the technology sector that has driven market performance. Market sentiment indicators are flashing warning signs across multiple timeframes. The VIX volatility index remains elevated, insider selling has accelerated, and margin debt levels suggest excessive speculation. While sentiment indicators aren't perfect timing tools, the combination of negative signals suggests increased market fragility. The equity market's dependence on Federal Reserve policy has created a dangerous addiction. Every market decline since 2008 has been met with additional monetary stimulus, training investors to buy the dip, regardless of fundamentals. But with inflation still elevated and the Fed's credibility at stake, the central bank may not be able to rescue markets as it has in the past. As we examine the specific vulnerabilities in dividend-paying stocks and commercial real estate in the following sections, it becomes clear that the equity market's problems extend far beyond simple overvaluation. The entire structure of modern equity markets has been distorted by over a decade of monetary manipulation, and the normalization process will be far more painful than most investors anticipate. For decades, dividend-paying stocks have been the cornerstone of conservative investment portfolios. Retirees, pension funds, and risk-averse investors have flocked to companies that provide steady income streams through regular dividend payments. But the fundamental mathematics of income investing have shifted dramatically, turning these supposedly safe investments into potential wealth destroyers in the new interest rate environment. The core problem is simple arithmetic that many investors refuse to acknowledge. When the 10-year Treasury bond yields 4.5% with virtually no credit risk, why would any rational investor accept 2.5% from a dividend-paying stock that carries significant business and market risk? Yet this is exactly the situation facing most dividend stocks today. The average dividend yield of the S&P 500 stands at just 1.5% according to FactSet data, making these stocks mathematically inferior to risk-free government bonds. Utility stocks, long considered the safest dividend plays, exemplify this problem. Companies like Consolidated Edison, Duke Energy, and Southern Company have built their investment appeal around steady 4 to 5% dividend yields. But these companies face unprecedented challenges that threaten both their dividend sustainability and their stock prices. The transition to renewable energy requires massive capital investments that these companies cannot afford while maintaining current dividend levels. The regulatory environment for utilities is becoming increasingly hostile. State public utility commissions are under political pressure to keep electricity rates low while simultaneously mandating expensive grid modernization and renewable energy investments. This regulatory squeeze is crushing utility profit margins and forcing companies to choose between maintaining dividends and funding necessary infrastructure investments. Real estate investment trusts, REITs, present an even more dangerous dividend trap. These companies are required by law to distribute at least 90% of their taxable income as dividends, which sounds attractive until you realize that this requirement prevents them from retaining earnings for growth or financial flexibility. With commercial real estate values declining and financing costs soaring, many REITs are paying dividends with borrowed money rather than operating cash flow. The office REIT sector is facing an existential crisis. Companies like Boston Properties and SL Green Realty have seen their dividend coverage ratios deteriorate as office occupancy rates remain well below pre-pandemic levels. The permanent shift to remote and hybrid work has reduced demand for office space by an estimated 20 to 30%, according to CBRE data. Yet these REITs continue paying dividends as if nothing has changed. Retail REITs face similar challenges as e-commerce continues to displace physical retail. Simon Property Group and other mall operators are struggling to maintain occupancy rates and rental income. Yet they continue paying substantial dividends to maintain their stock prices. This is a classic example of paying dividends to support the stock price rather than reflecting genuine business performance. Telecommunications companies represent another dividend trap that has ensnared income-focused investors. AT&T and Verizon have historically paid attractive dividends. But both companies face massive capital requirements for 5G network build-outs, while their traditional revenue streams decline. AT&T was forced to cut its dividend by nearly 50% in 2022, wiping out years of income for dividend-focused investors. The energy sector's dividend sustainability is questionable despite recent strong performance. Companies like ExxonMobil and Chevron have restored their dividends after cutting them during the 2020 oil price collapse, but their long-term prospects remain uncertain. The global transition to renewable energy, combined with volatile commodity prices, makes energy dividends inherently unstable, regardless of current cash flow levels. Consumer staples companies, traditionally viewed as defensive dividend plays, are struggling with margin compression and changing consumer preferences. Companies like Procter & Gamble and Coca-Cola face rising input costs, supply chain disruptions, and shifts toward private label products. Their ability to maintain dividend growth while investing in business transformation is increasingly questionable. The pharmaceutical sector's dividend sustainability is threatened by patent cliffs and regulatory pressures. Companies like Pfizer and Johnson & Johnson face massive revenue declines as key patents expire. Yet they continue paying dividends that consume most of their free cash flow. The industry's high research and development costs, combined with uncertain drug approval processes, make dividend sustainability problematic. Financial sector dividends face regulatory constraints and credit cycle risks. Banks like J.P. Morgan Chase and Bank of America are subject to stress tests that can force dividend cuts during economic downturns. With commercial real estate loans souring and consumer credit deteriorating, bank dividend sustainability is far from certain despite current strong earnings. The dividend coverage ratio, the relationship between earnings and dividend payments, has deteriorated across most sectors. According to FactSet data, the average S&P 500 company pays out over 40% of its earnings as dividends, up from 30% a decade ago. This leaves less financial flexibility for companies to weather economic storms or invest in growth opportunities. Many companies are using financial engineering to maintain dividend payments despite deteriorating fundamentals. Share buybacks funded with debt can artificially boost earnings per share, making dividend coverage ratios appear healthier than they actually are. Companies are also using non-GAAP earnings metrics that exclude various charges to present inflated dividend coverage calculations. The tax implications of dividend investing have become less favorable for many investors. The Tax Cuts and Jobs Act of 2017 reduced the appeal of dividend income relative to capital gains for high-income investors. Additionally, many states have increased taxes on dividend income, further reducing the after-tax appeal of dividend-focused strategies. International dividend stocks face additional currency risks that many investors overlook. European and Asian companies may pay attractive dividend yields in local currency terms, but currency fluctuations can eliminate these gains for dollar-based investors. The British pound's decline has devastated returns for U.S. investors in UK dividend stocks, regardless of the company's local performance. Dividend-focused mutual funds and ETFs have attracted massive inflows from yield-starved investors, creating artificial demand for dividend-paying stocks. The Vanguard Dividend Appreciation ETF and similar funds manage hundreds of billions in assets, but their mechanical buying has inflated valuations beyond reasonable levels. When these flows reverse, dividend stocks could face severe selling pressure. The demographic argument for dividend stocks, that aging baby boomers need income, is actually working against these investments. As retirees shift from accumulation to distribution mode, they're becoming net sellers of all stocks, including dividend payers, The supposed natural demand for dividend stocks is actually declining as the baby boom generation ages. Dividend aristocrats, companies that have increased their dividends for 25 consecutive years, are particularly vulnerable to the changing environment. Many of these companies achieved their dividend growth records during the declining interest rate environment of the past 4 decades. As rates normalize, maintaining dividend growth becomes much more challenging. The quality of dividend payments has deteriorated significantly. Many companies are borrowing money to pay dividends, effectively returning shareholders' own capital rather than distributing genuine profits. This practice is unsustainable and represents a form of financial fraud that regulators have largely ignored. Dividend reinvestment plans (DRIPs), once considered the foundation of long-term wealth building, are becoming wealth destruction vehicles in overvalued markets. Automatically reinvesting dividends at inflated prices compounds the problem of poor initial valuations. Investors would be better served taking dividends in cash and waiting for better investment opportunities. The behavioral aspects of dividend investing work against investors in declining markets. The psychological appeal of receiving regular income payments causes investors to hold on to declining stocks longer than they should. This dividend yield trap has destroyed more wealth than most investors realize, as they focus on income while ignoring capital depreciation. Sector rotation patterns are working against traditional dividend stocks. As economic growth accelerates and interest rates rise, investors typically rotate from defensive dividend-paying sectors toward growth-oriented sectors. This rotation can persist for years, leaving dividend stock investors behind, regardless of the company's fundamental performance. The options market provides additional evidence of dividend stock vulnerability. Put option volumes on dividend-heavy sectors like utilities and REITs have increased significantly, suggesting that sophisticated investors are hedging against potential declines. When professional money managers are buying insurance against dividend stock declines, retail investors should take notice. As we examine the commercial real estate crisis in the next section, it becomes clear that many dividend-paying REITs are sitting on massive unrealized losses that will eventually force dividend cuts. The interconnected nature of these problems means that the dividend stock crisis is just beginning, not ending. The era of dividend investing as a conservative strategy is over. In a world where risk-free bonds yield more than most dividend stocks, and where the underlying businesses face unprecedented challenges, dividend-focused investing has become a recipe for wealth destruction rather than wealth preservation. Commercial real estate, once considered one of the most stable and predictable asset classes, is facing an unprecedented crisis that threatens to destroy trillions of dollars in value and trigger a cascade of financial failures throughout the banking system. The perfect storm of structural changes, technological disruption, and financial leverage has created conditions for what could be the most severe real estate collapse in modern history. The numbers are staggering and getting worse by the quarter. According to CBRE data, office vacancy rates in major U.S. cities have reached 20%. The highest level since the 2008 financial crisis. But unlike previous downturns, this isn't a cyclical problem that will resolve with economic recovery. It's a structural shift that permanently reduces demand for commercial space. The work-from-home revolution has fundamentally altered how businesses operate, and there's no going back. San Francisco, once the crown jewel of commercial real estate markets, exemplifies the crisis. Office vacancy rates in the city have exceeded 25%, and asking rents have fallen by over 30% from peak levels, according to JLL research. Major tenants like Salesforce, Twitter, and Meta have either downsized significantly or abandoned their leases entirely. The ripple effects extend far beyond landlords to restaurants, retail shops, and service businesses that depend on office workers. The financial engineering that inflated commercial real estate values is now working in reverse. During the low interest rate era, investors used massive leverage to acquire properties, often borrowing 70 to 80% of the purchase price. A $100 million office building purchased with $80 million in debt seemed like a safe investment when cap rates were 4% and borrowing costs were 2%. But when the building's value falls to $60 million and the debt remains at $80 million, the owner is underwater by $20 million. Regional banks are particularly exposed to commercial real estate losses. According to Federal Reserve data, regional banks hold over $2.7 trillion in commercial real estate loans, representing nearly 30% of their total loan portfolios. Unlike residential mortgages, which are often sold to government-sponsored enterprises, commercial real estate loans typically remain on bank balance sheets. This concentration creates systemic risk that regulators are only beginning to acknowledge. The office sector faces the most severe challenges, but retail real estate is also in crisis. E-commerce penetration reached 15.6% of total retail sales in 2023, according to Census Bureau data, and this percentage continues growing. Traditional shopping malls are becoming obsolete as anchor tenants like Sears, JCPenney, and Macy's close stores or declare bankruptcy. The retail apocalypse that began before the pandemic has accelerated dramatically. Even seemingly stable retail categories are under pressure. Grocery stores, once considered recession-proof tenants, are facing competition from online delivery services and changing consumer preferences. CVS and Walgreens have announced plans to close thousands of locations as prescription fulfillment moves online and consumers shift to digital services. The hotel and hospitality sector represents another area of commercial real estate distress. Business travel has permanently declined as companies embrace video conferencing and reduce travel budgets. According to the Global Business Travel Association, corporate travel spending remains 20% below pre-pandemic levels and may never fully recover. Hotels that cater to business travelers are facing permanently impaired cash flows. Industrial real estate, particularly warehouses and distribution centers, initially benefited from e-commerce growth. But even this sector is showing signs of overbuilding and speculation. Amazon and other major tenants are reducing their warehouse footprints as they optimize their logistics networks. The industrial real estate boom of 2022 created oversupply in many markets that will take years to absorb. The refinancing crisis is just beginning to unfold. According to Mortgage Bankers Association data, over $1.5 trillion in commercial real estate debt will mature between 2024 and 2028. Much of this debt was originated when property values were at peak levels and interest rates were near zero. Borrowers who need to refinance are discovering that their properties are worth less than their outstanding debt, creating a massive refinancing gap. Commercial mortgage-backed securities, CMBS markets, are showing severe stress. CMBS delinquency rates have increased to over 4% according to TREP data. And this figure understates the problem because many borrowers are making interest-only payments while hoping for market recovery. The CMBS market, worth over $500 billion. could face widespread defaults as properties fail to generate sufficient cash flow to service their debt. Life insurance companies and pension funds, which invested heavily in commercial real estate during the low-rate era, are facing massive unrealized losses. These institutions allocated to real estate seeking higher yields than government bonds could provide. But they're discovering that real estate can be far more volatile than traditional fixed-income investments. Some pension funds are marking down their real estate holdings by 20 to 30%, creating funding shortfalls that will require increased contributions or reduced benefits. Real estate investment trusts, REITs, are particularly vulnerable because they're required to distribute most of their income as dividends, leaving little retained earnings to weather downturns. Office REITs, like Boston Properties and SL Green Realty, have seen their share prices fall by 50 to 70% from peak levels, yet they continue paying dividends that exceed their current cash flow generation. This is unsustainable and will likely result in dividend cuts that further depress share prices. The construction industry is already responding to reduced demand. Commercial construction starts fell by 15% in 2023, according to Dodge Construction Network data, and the pipeline of new projects continues shrinking. This reduction in new supply might eventually help existing properties, but the adjustment period could last years given the magnitude of current oversupply. Foreign investment in U.S. commercial real estate has virtually disappeared. Chinese investors, who were major buyers of trophy properties during the 2010s, have been largely absent from the market since 2020. Due to capital controls and geopolitical tensions, European and Middle Eastern investors are also reducing their U.S. real estate allocations as they focus on domestic opportunities. The technology sector's real estate footprint is shrinking dramatically. Tech companies were major drivers of office demand during the 2010s, but they're now leading the downsizing trend. Meta has given back millions of square feet of office space, and even growing companies like Google are reducing their real estate commitments. The tech sector's embrace of remote work is particularly damaging because these companies typically paid premium rents for high-quality space. Co-working spaces, which were supposed to represent the future of office usage, have largely failed. WeWork's bankruptcy in 2023 highlighted the fundamental flaws in the co-working model, and most other operators are struggling with low occupancy rates and unprofitable unit economics. The flexible workspace concept hasn't solved the fundamental problem of reduced office demand. Government and municipal real estate faces its own challenges. Many cities are struggling with reduced tax revenues as commercial property values decline, creating budget shortfalls that force service cuts and tax increases. The fiscal crisis facing cities like San Francisco and New York is partly attributable to the collapse in commercial real estate values and the associated property tax revenues. The environmental, social, and governance ESG movement is creating additional pressures on commercial real estate. Older buildings that don't meet modern energy efficiency standards are becoming obsolete. As tenants demand sustainable space, the cost of retrofitting older buildings to meet ESG requirements often exceeds their current market value, making renovation economically unfeasible. International commercial real estate markets are facing similar pressures. London's office market has been devastated by Brexit and remote work trends. Chinese commercial real estate is in crisis as the country's property development model collapses. European markets are struggling with energy costs and economic stagnation. This is a global phenomenon, not just an American problem. The derivatives market tied to commercial real estate is adding leverage and complexity to the crisis. Commercial real estate derivatives, including total return swaps and synthetic CDOs, have a notional value exceeding $200 billion, according to industry estimates. These instruments can amplify losses and create forced selling that accelerates price declines. Opportunity funds and distressed debt investors are beginning to circle commercial real estate markets, but even they're proceeding cautiously. The scale of potential losses is so large that even well-capitalized distressed investors are waiting for further price declines before deploying capital. This lack of buyer interest is preventing price discovery and prolonging the crisis. The commercial real estate crisis isn't just about property values, it's about the entire ecosystem of businesses, jobs, and economic activity that depends on commercial real estate. When office buildings empty, the restaurants, dry cleaners, parking garages, and countless other businesses that serve office workers also fail. This multiplier effect amplifies the economic damage far beyond the direct real estate losses, as we'll explore in the next section. The collapse in commercial real estate values is creating opportunities in alternative asset classes. But for investors and institutions heavily exposed to commercial real estate, the coming years will bring unprecedented losses that will reshape the financial landscape for decades to come. While traditional assets crumble under the weight of monetary policy, normalization, and structural economic changes, sophisticated investors aren't sitting idle. They're executing the largest capital reallocation in modern history. Moving trillions of dollars from failing asset classes into investments positioned to thrive in the new economic paradigm, understanding these flows isn't just academic, it's the difference between financial survival and prosperity in the coming decade. Gold and precious metals are experiencing their most significant institutional adoption since the 1970s. Central bank gold purchases reached 1,037 tons in 2023, according to the World Gold Council, the highest level in 55 years. But this isn't just emerging market central banks. Diversifying away from dollars, developed nation central banks are also accumulating gold. The Polish National Bank increased its gold reserves by 100 tons in 2023, while the Czech National Bank doubled its holdings. The mathematics of gold ownership have fundamentally shifted. When treasury bonds yielded near zero, gold's lack of yield was a disadvantage. But when real interest rates, nominal rates minus inflation, remain negative or barely positive, gold becomes competitive with traditional fixed income investments. More importantly, gold provides insurance against currency debasement and financial system instability that bonds cannot offer. Mining companies are benefiting from both higher gold prices and improved operational efficiency. Newmont Corporation and Barrick Gold have streamlined their operations and reduced costs, while gold prices have appreciated. But the real opportunity lies in smaller, high-quality miners that are trading at significant discounts to their net asset values. Companies like Agnico, Eagle Mines, and Kirkland Lake Gold offer leveraged exposure to gold price appreciation. Silver presents an even more compelling opportunity due to its dual role as both a monetary metal and an industrial commodity. The global transition to renewable energy requires massive amounts of silver for solar panels, electric vehicle batteries, and power grid infrastructure. According to the Silver Institute, industrial demand for silver is expected to grow by 15% annually through 2030, while mine supply remains constrained. Energy infrastructure represents another major destination for smart money flows, while environmental activists focus on eliminating fossil fuels. The reality is that global energy demand continues growing, and renewable sources cannot meet this demand alone. Natural gas, in particular, is experiencing a renaissance as countries recognize its role as a bridge fuel in the energy transition. Pipeline companies like Kinder Morgan and Enterprise Products Partners offer attractive yields backed by long-term contracts and essential infrastructure. These companies generate cash flows that are largely independent of commodity price volatility because they earn fees for transporting energy rather than owning the underlying commodities. Their dividend yields of 6 to 8% are backed by genuine cash flow generation. Unlike many traditional dividend stocks, the uranium market is experiencing a supply-demand imbalance that could persist for decades. Nuclear power is being recognized as essential for meeting climate goals while maintaining energy security. Countries like France, South Korea, and even Germany are reconsidering their nuclear policies. Uranium prices have increased from $20 per pound in 2022 over $80 per pound in 2024. But this may be just the beginning of a multi-year bull market. Uranium mining companies like Cameco Corporation and Kazatomprom are benefiting from both higher prices and supply constraints. The uranium market is relatively small, with total annual production worth less than $10 billion, making it susceptible to dramatic price moves when supply-demand dynamics shift. Institutional investors are beginning to allocate to uranium as both an energy play and an inflation hedge. Technology infrastructure, particularly data centers and telecommunications towers, represents a secular growth opportunity that transcends economic cycles. The artificial intelligence revolution requires massive computational power, driving unprecedented demand for data center capacity. Companies like Digital Realty Trust and American Tower Corporation own the physical infrastructure that enables the digital economy. The 5G wireless build-out is creating similar opportunities in telecommunications infrastructure. Crown Castle International and SBA Communications own the cell towers that wireless carriers need to deploy 5G networks. These companies generate predictable cash flows through long-term lease agreements with creditworthy tenants, providing inflation protection and steady income growth. Semiconductor companies positioned in strategic parts of the supply chain offer exposure to multiple technological megatrends. Taiwan Semiconductor Manufacturing Company, TSMC, and ASML holding are essential links in the global chip supply chain that cannot be easily replicated. Their technological moats and strategic importance provide pricing power and growth visibility that few companies can match. Water infrastructure represents one of the most overlooked investment opportunities of the coming decade. Global water scarcity is worsening due to climate change, population growth, and industrial development. Companies like American Waterworks and Essential Utilities own regulated water utilities that provide essential services with predictable cash flows and inflation protection. Water treatment and purification technology, companies like Xylem and Danaher offer exposure to the growing need for water infrastructure investment. The American Society of Civil Engineers estimates that the United States alone needs $2.2 trillion in water infrastructure investment over the next 20 years, creating massive opportunities for companies with the right technologies and capabilities. Agricultural land and farmland REITs are attracting institutional capital as food security becomes a geopolitical priority. Farmland Partners and Gladstone Land own high-quality agricultural real estate that generates income through crop production while providing inflation protection through land appreciation. Global food demand continues growing, while arable land remains finite, creating favorable long-term supply-demand dynamics. Commodity-focused investments are benefiting from years of underinvestment in mining and energy production. The ESG movement discouraged investment in extractive industries, creating supply constraints that are now manifesting as higher prices. Companies like Freeport-McMoRan Copper and Nutrien Fertilizer are positioned to benefit from these supply-demand imbalances. Bitcoin and cryptocurrency infrastructure are maturing into institutional asset classes. While Bitcoin remains volatile, its adoption by corporations like MicroStrategy and Tesla, and its approval for ETF inclusion signal growing institutional acceptance. More importantly, the infrastructure supporting cryptocurrency, including exchanges, custody services, and payment processors, is generating substantial cash flows. Coinbase Global, despite its volatility, is building a dominant position in cryptocurrency infrastructure. The company generates revenue from trading fees, custody services, and institutional products that grow with cryptocurrency adoption regardless of price movements. As regulatory clarity improves, Coinbase's competitive advantages should become more apparent. Defense and aerospace companies are benefiting from increased global military spending and the commercialization of space. Lockheed Martin and Raytheon Technologies have substantial order backlogs driven by geopolitical tensions and military modernization programs. The space economy, including satellite communications and space exploration, represents a new frontier for investment opportunities. Logistics and supply chain infrastructure companies are positioned to benefit from reshoring trends and supply chain diversification. Prologis and Extended Stay America own the warehouses and distribution centers that enable modern commerce. The shift from just-in-time to just-in-case inventory management is driving demand for additional storage and logistics capacity. Healthcare infrastructure, including hospitals and medical office buildings, offers defensive characteristics with growth potential. An aging global population requires increasing healthcare services, creating steady demand for medical facilities. Healthcare REITs like Welltower and Ventus own properties leased to healthcare providers. Generating predictable cash flows with inflation protection, intellectual property and royalty investments provide exposure to innovation and creativity without operational risk. Companies like Texas Pacific Land and Franco-Nevada own royalty interests in oil, gas, and mining properties, generating cash flows without operational responsibilities. These royalty models are expanding into technology, pharmaceuticals, and entertainment. The key to successful investing in this environment is understanding that traditional diversification models no longer work. The 60/40th stock bond portfolio that dominated institutional investing for decades failed spectacularly in 2022 when both stocks and bonds declined simultaneously. The new paradigm requires diversification across asset classes that respond differently to inflation, currency debasement, and economic disruption. Smart money is also focusing on companies with pricing power, the ability to raise prices faster than costs increase. This characteristic is essential in an inflationary environment and separates winners from losers across all sectors. Companies with strong brands, essential products, or monopolistic positions can maintain margins, while others struggle. Geographic diversification is becoming increasingly important as different regions face varying economic and political challenges. Emerging markets offer growth opportunities but carry currency and political risks. Developed markets provide stability but face demographic headwinds. The optimal approach involves selective exposure to the best opportunities in each region while avoiding concentrated risks. As we examine the strategic mindset required for navigating this transformation, it becomes clear that successful investing in 2025 and beyond requires abandoning conventional wisdom and embracing a more dynamic, opportunistic approach to capital allocation. Success in the coming financial transformation requires more than just knowing which assets to buy or sell. It demands a fundamental shift in how you think about money, risk, and opportunity. The investors who will thrive in 2025 and beyond are those who can break free from conventional wisdom and develop what we call the contrarian mindset, the ability to see opportunity where others see only crisis, to act when others are paralyzed by fear, and to think independently when the crowd is following failed strategies. The first principle of contrarian thinking is understanding that markets are driven by human psychology, not mathematical models. The efficient market hypothesis, the idea that markets always price assets correctly, has been thoroughly debunked by decades of behavioral finance research. Markets regularly overshoot in both directions, creating massive opportunities for investors who can maintain emotional discipline and think independently. Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful isn't just a catchy phrase, it's a mathematical reality. The best investment opportunities occur when assets are priced below their intrinsic value due to temporary market dislocations. But recognizing these opportunities requires the psychological fortitude to act against prevailing sentiment, and the analytical skills to distinguish between temporary problems and permanent impairments. The concept of asymmetric risk-reward is central to contrarian investing. This means seeking investments where the potential upside significantly exceeds the potential downside. For example, buying gold mining stocks when gold is out of favor offers limited downside. If you're wrong, but massive upside if commodity cycles turn positive, the key is finding situations where the market has overreacted to negative news, creating opportunities for patient investors. Timing is crucial, but not in the way most people think. Contrarian investors don't try to time exact market tops and bottoms. That's impossible and unnecessary. Instead, they focus on identifying major trend changes and positioning themselves early in news cycles. The goal isn't to buy at the absolute bottom, but to buy when assets are significantly undervalued. Relative to their long-term prospects, the importance of independent research cannot be overstated. Wall Street analysts, financial media, and conventional wisdom are often wrong at critical turning points because they're influenced by the same psychological biases that affect all market participants. Contrarian investors develop their own analytical frameworks and information sources, allowing them to reach different conclusions than the consensus. Understanding monetary policy cycles is essential for contrarian success. Central bank policies create artificial booms and busts that savvy investors can exploit. When central banks suppress interest rates, they create asset bubbles that eventually burst. When they raise rates aggressively, they create opportunities to buy quality assets at discounted prices. The key is recognizing where you are in the cycle and positioning accordingly. Diversification must be reconceptualized for the modern era. Traditional diversification, spreading investments across different stocks and bonds, provides little protection when entire asset classes move together. True diversification requires exposure to assets that respond differently to various economic scenarios: inflation, deflation, currency debasement, economic growth, and geopolitical instability. The concept of hard assets versus paper assets becomes crucial in an era of currency debasement. Hard assets, real estate, commodities, precious metals, productive businesses, maintain their value over time because they represent real economic value. Paper assets, bonds, cash, financial derivatives, are claims on future payments that can be devalued through inflation or default. Contrarian investors favor hard assets during periods of monetary instability. Leverage is a double-edged sword that must be used carefully. While leverage can amplify returns, it can also amplify losses and force investors to sell at the worst possible times. The key is using leverage only when you have high conviction in your analysis and when the risk-reward ratio is strongly in your favor. Many of the best contrarian opportunities don't require leverage because the underlying value proposition is so compelling. The importance of liquidity management cannot be ignored. Contrarian investors need cash available to take advantage of opportunities when they arise. This means maintaining higher cash positions than conventional wisdom suggests, even when cash yields are low. The opportunity cost of holding cash is often more than offset by the ability to deploy it when exceptional opportunities emerge. Psychological preparation is as important as financial preparation. Contrarian investing requires the ability to withstand criticism, doubt, and temporary losses while waiting for your thesis to play out. This psychological resilience can be developed through education, experience, and maintaining a long-term perspective. Understanding market history helps investors recognize that current conditions, no matter how extreme they seem, are part of recurring cycles. The role of government and central bank intervention must be factored into all investment decisions. Modern markets are heavily influenced by policy decisions that can override fundamental economic forces for extended periods. Contrarian investors must understand policy trends and position themselves to benefit from policy changes rather than fighting against them. Technology is creating new categories of contrarian opportunities. The artificial intelligence revolution, blockchain technology, and renewable energy transition are creating winners and losers that may not be apparent for years. Contrarian investors can position themselves in undervalued companies that will benefit from these technological shifts, while avoiding overvalued companies that will be disrupted. Geographic arbitrage offers opportunities for contrarian investors willing to look beyond their home markets. Different countries and regions are at different stages of economic and market cycles, creating opportunities to buy assets cheaply in one market while selling expensive assets in another. This requires understanding global economic trends and currency dynamics. The importance of studying financial history cannot be overstated. While specific events don't repeat exactly, the underlying patterns of human behavior and market dynamics are remarkably consistent across time and geography. Investors who understand how previous financial crises unfolded can better position themselves for current and future disruptions. Risk management is the foundation of successful contrarian investing. This doesn't mean avoiding risk. It means understanding and managing risk appropriately. The biggest risk is often not taking enough risk when opportunities are abundant, while the second biggest risk is taking too much risk when opportunities are scarce. Successful contrarians calibrate their risk-taking to match available opportunities. The concept of optionality is crucial for navigating uncertain environments. This means structuring investments to benefit from positive surprises, while limiting downside exposure. For example, Owning small positions in volatile assets, like cryptocurrency or junior mining stocks, provides exposure to potentially massive gains while limiting losses to the initial investment amount. Building multiple income streams reduces dependence on any single source of returns. This might include dividend-paying stocks, rental real estate, royalty investments, and business ownership. Diversified income streams provide stability during market volatility and reduce the need to sell assets at inopportune times. The importance of continuous learning and adaptation cannot be ignored. Markets evolve constantly, and strategies that worked in the past may not work in the future. Successful contrarian investors remain students of the markets throughout their careers, constantly updating their knowledge and refining their approaches based on new information and changing conditions. Network effects and information advantages become increasingly important in competitive markets. Building relationships with other sophisticated investors, industry experts, and information sources can provide insights that aren't available to the general public. This doesn't mean seeking insider information. It means developing a network that helps you understand trends and opportunities before they become obvious to everyone else. The contrarian mindset also requires humility and the willingness to admit mistakes. Even the best investors are wrong frequently, and the ability to cut losses quickly and learn from mistakes is essential for long-term success. Pride and ego are the enemies of successful investing because they prevent investors from adapting to changing circumstances. As we prepare to conclude our analysis with specific action steps and recommendations, remember that developing a contrarian mindset is a process, not a destination. It requires constant vigilance against the psychological biases that affect all investors and the discipline to act on your convictions, even when doing so feels uncomfortable or unpopular. The time for passive observation is over. The financial transformation we have discussed is not a distant possibility. It is happening now and accelerating each month. The question is not whether these changes will happen, but whether you will be positioned to profit from them or become another victim of financial ignorance. This final section offers a concrete action plan to navigate the upcoming reset and emerge stronger. The first step is to conduct a harsh assessment of your current financial situation. Most people have never honestly assessed their exposure to the vulnerable asset classes we have discussed. Calculate precisely how much of your wealth is in long-term bonds, dividend-focused stocks, commercial real estate, and cash positions that are losing purchasing power daily. This is not about judgment. It is about facing reality. You cannot solve problems you refuse to acknowledge. Create a timeline for repositioning your portfolio based on your unique circumstances. If you are heavily invested in vulnerable assets through retirement accounts, you may need to make changes gradually to minimize tax consequences. If you have more flexibility, you can act more aggressively. The essential thing is to have a plan rather than reacting emotionally to market fluctuations. Establish a core position in monetary metals as insurance against currency debasement and financial system instability. This does not mean putting everything into gold and silver, but it does mean having significant exposure, typically 10 to 20% of investable assets for most investors. Physical metals offer the ultimate insurance policy, while mining stocks provide leveraged exposure to price increases. Build exposure to energy infrastructure and commodity-producing assets that will benefit from years of underinvestment and growing global demand. This includes pipeline companies, uranium miners, agricultural land, and water infrastructure. These assets offer protection against inflation and generate cash flows that increase with commodity prices. Develop positions in technology infrastructure companies that support the digital economy. Rather than in speculative technology stocks with no earnings, data centers, cell towers, semiconductor equipment manufacturers, and cybersecurity companies provide exposure to technological progress without the volatility of speculative growth stocks. Create geographic diversification beyond the assets of your home country. This could include emerging market exposure through commodity-producing countries, developed market exposure through European or Asian infrastructure companies, or currency diversification through foreign real estate or international bonds. The objective is to reduce dependence on any single country's economic and political stability. Establish multiple income streams that are not dependent on traditional employment or investment dividends. This might involve rental real estate in growing markets, royalty investments, business ownership, or developing skills that can generate consulting income. Multiple income streams provide stability during economic transitions and lessen dependence on volatile investment returns. Build a substantial cash position despite low interest rates, but manage this cash strategically. Instead of keeping everything in bank deposits, consider treasury bills, money market funds, or even foreign currency deposits. The goal is to maintain liquidity to capitalize on opportunities while protecting purchasing power as much as possible. Develop relationships with like-minded investors and financial professionals who understand the changing environment. This is not about finding people who agree with you on everything, but about building a network of informed individuals who can offer different perspectives and investment ideas. Join investment clubs, attend conferences, or participate in online communities focused on alternative investing. Continuously educate yourself about monetary policy, geopolitical trends, and market cycles. The investors who profit most from major transitions are those who understand the underlying forces driving the change. Read books on financial history, follow independent analysts who are not tied to Wall Street, and develop your own analytical framework for evaluating opportunities. Consider the tax implications of your repositioning strategy and structure your moves to minimize unnecessary tax burdens. This might involve using tax-advantaged accounts for certain investments, harvesting losses to offset gains, or timing transactions to optimize tax efficiency. Do not let tax considerations prevent necessary changes, but do not ignore them either. Prepare for increased volatility and maintain emotional discipline during market turbulence. The transition period will be marked by extreme price movements in both directions as markets adapt to new realities. Having a clear plan and sticking to it during volatile times is crucial for long-term success. Build physical resilience alongside financial resilience. This might include owning real estate in stable locations, maintaining emergency supplies, developing practical skills, and fostering community relationships. Financial preparation is important, but it is not enough if the broader social and economic system becomes unstable. Stay informed about policy changes and regulatory developments that could affect your investments. Government responses to financial crises are often unpredictable and can dramatically alter investment returns. Understanding policy trends and positioning yourself accordingly can be the difference between success and failure. Consider the generational implications of your investment decisions. The changes we are facing will likely continue for decades, affecting not only your financial future, but also that of your children and grandchildren. Building generational wealth requires thinking beyond short-term market movements to long-term structural trends. Develop contingency plans for different scenarios, rather than betting everything on a single outcome. While we have outlined the most likely developments, financial markets can surprise even seasoned analysts. Having plans for various scenarios: inflation, deflation, a currency crisis, geopolitical instability, provides the flexibility to adapt as conditions change. Monitor key indicators that signal an acceleration or deceleration of the trends we have discussed. These might include central bank gold purchases, commercial real estate delinquency rates, currency volatility, or commodity price movements. Understanding these indicators helps you adjust your position as conditions evolve. Maintain a long-term perspective while remaining tactically flexible. The major trends we have analyzed will likely persist for years or even decades, but the specific timing and scale of changes are still uncertain. Having conviction in your long-term thesis while staying flexible with short-term tactics is essential for navigating uncertainty. Remember that the greatest opportunities often emerge during periods of maximum pessimism and uncertainty. When others are panicking about financial system stability, currency debasement, or economic collapse. Patient investors with capital and conviction can acquire assets at generational lows. The key is to be prepared financially and psychologically to act when others cannot. The financial reset of 2025 marks both the end of one era and the start of a new one. The monetary system that has prevailed for the past 50 years is collapsing. But this collapse creates opportunities for those who understand what is happening and position themselves accordingly. The investors who will succeed in the coming decade are those who act now before the changes become apparent to everyone else. This is not about predicting the future with perfect accuracy, but about understanding the direction of change and positioning yourself to benefit regardless of the specific timing or magnitude of events. The trends we have analyzed are already underway, driven by mathematical realities that cannot be wished away or solved with political rhetoric. The choice is yours. You can either continue to follow conventional wisdom and hope the problems resolve themselves, or you can take control of your financial future by positioning yourself ahead of the coming changes. The window for repositioning is still open, but it will not stay open forever. At Contrarian Edge, we believe that informed investors who think independently and act decisively will not just survive the coming financial reset. They will thrive in ways that seemed impossible under the old system. The greatest wealth transfers in history happened during periods of maximum change, and we are entering such a period now. If this analysis has provided value and helped you understand the challenges and opportunities that lie ahead, please take a moment to like this content, subscribe to our channel, and share it with others who need to hear this message. The more people who understand what is happening, the better prepared we will all be for the changes to come. Leave a comment below, sharing your biggest takeaway from this analysis, or your most pressing concern about the financial changes of 2025. Your engagement helps us create better content and builds a community of informed investors who can learn from one another. Remember, when others panic, we prepare. When others follow, we lead. The great financial reset is coming, whether we are ready or not. The only question is whether you will be positioned to profit from it or become another casualty of financial ignorance. The future belongs to those who prepare for it today. Make sure you are ready.